Hello guys, welcome to lesson 2 of the course, and today we're going to talk about open float and utilizing IPDA data ranges. You can see, if you look at the top right hand corner of my screen, you're going to see that the time is 2:03 a.m. and I mentioned before that the preparation of these lessons, especially for that time frame series, it is the bulkiest of all the lessons, and I've been working on the preparation since 12:43 a.m. my time, so that's over an hour ago. I've been working on the preparation. You can see I'm just getting into making a video around 2 a.m. and I'm hoping that this does not go over an hour, because I've tried to summarize the very key points we need to discuss in this lesson. So let's see what happens. But we're gonna go and delve into this and delve into our analysis. Alright, so we're gonna start with defining what open float is in price. Okay. Alright, so what is open float? Open float is the current open interest above and below market price. Okay, so let's type this out. So it is defined open float is the current open interest above and below market price. Okay, so when I say market price, I mean current market price. Open interest comes in form of pending buy orders resting above old highs in form of buy sell liquidity, and vice versa for old lows in form of sell side liquidity. Okay, when we talk about current open interest, and keyword in the definition of open float is current, okay, meaning existing open interest. Open interest, the word there simply means liquidity. If you have an interest in an asset, you're taking an execution in that asset. Now your liquidity, when you take an execution on a pair or an asset, your liquidity is now imputed into the marketplace. So when we talk about current open interest above and below marketplace, we're talking about current liquidity above and below market price. That's essentially what we mean. Okay, so when we talk about open float liquidity, or when we talk about open flow, we simply mean the total open interest of market participants total open interest of market participants that are in the marketplace or hope to be in the marketplace, depending on when price goes relative to their pending orders. So when we talk about open interest, okay, we're talking about participants with pre-existing liquidity in price and then pending liquidity in price. So that pending liquidity is going to be in form of buy stops above old highs, limit orders in form of protective sell stops, protective buy stops above old highs, and then we're talking about sell limit orders below old lows and protective sell stops below old lows. That's what we mean by pending, because the liquidity is not being activated yet. Okay, so just to sum up what open float is in terms of current open interest above and below market price. Now, the reason why we use above and below market price is because that's typically where we will have a buildup of liquidity or a liquidity pool, which is external to a price range. Okay, so let's define open float for an old high in form of buy stop. So when we're talking about the buy side, open float, we're talking about protected shorts in form of buy stops above the last bearish shift. It could be within the last 20 days, last 40 days, the last 60 days. Okay, we're looking at the last bearish shift on the higher time frame, and I will explain why. So when we're dealing with higher time frame, we're dealing with fund level plays and fund level liquidity. It's gonna be buy stops above short-term high, buy stops above highest high in the last 3 months, buy stops above highest high in last 6 months. Okay, that's half a year's range of data, and it's all important to what you're going to see, because I'm going to use a current market price action to teach what I mean with the buy stops. And I know this sounds boring right now, but again, this is something you're going to have to see through if you're going to fully grasp the concept. And these are all valid for buy side open flow. Okay, and then if we're looking for sell side, okay, when we talk about buy side open flow, we're talking about pending liquidity or current existing liquidity above old highs, which is buy side, and then for old lows, which is the sell side. Okay, looking at protective longs, okay, in form of sell stops. So any long or bullish participant in the marketplace has to protect their long with a sell stop. So that means if they are wrong in price or they're wrong in their anticipation of delivery, they are executed out of the marketplace at a loss, okay, at a level where they want to be out of the marketplace. And that's how you get, a sell stop to protect the longs. And usually you're going to have sell stops protecting the longs above the last bullish shift, because again, these longs, you're looking at bullishness in the marketplace. Then you're going to have sell stops above a short-term low for the buy side. Then you're also going to have sell stops. Again, we're just reversing everything for the sell side above the highest low in the last 3 months. Again, sell stops above the highest low in the last 6 months, and that is for sell side liquidity. So this essentially defines open flow liquidity in price. Okay, you're going to have protected liquidity above short-term highs, highest high in the last 3 months, highest high in the last 6 months, and above a short-term or the last bearish shift in price. There will be a lot of fund level liquidity in form of protective orders or pending orders for new executions, and just reverse that for the sell side. Okay, and let's go into actual market price action. And what I have here is a chart of USD JPY or dollar yen. And you would see that compared to dollar, which has been stuck in the range since the start of the year. So if I just put up a line chart of dollar, if I put up a line chart of dollar and compared dollar against yen, you're gonna see that dollar's been stuck in the consolidation all year, and you can see that USD JPY has been actually trending, seeing higher prices, and it's made a higher low. Meanwhile, dollar stuck in a massive consolidation. Okay, so for dollar yen, let's define open flow liquidity in this market. Now what I'm gonna do is I'm gonna go all the way back, and you can see we had a parent price swing from this low all the way up to the high. So when I say parent price swing, I mean a pre-existing price swing prior to price trading out of that. So prior to the run out of this price swing, this was the highest high in that price swing, the lowest low in the price swing. So we're gonna define the range of our parent price swing. Okay, so let's use this. That is the lowest low of that price swing, and this is the highest high of the price swing. Okay, and then we have a discount, which is a bullshit block here, but that really is not of concern to us. All right, so now at the start of the year, we run external liquidity external to this parent price swing. Now, what would be resting below this long-term low? So what do we call that a long-term low? If you viewed price from the start of the year, which is 2023, so if I use a replay tool, and let's assume, okay, let's use the replay tool, start of the year. If I use a replay tool, the start of the year, and you cast it back, or you look back the last 3 months. So this is January, this is December, this is November, this is October, this is the last 3 months. Where is the lowest low in the last 3 months? That is current market price action. Okay, now if you went back 6 months, September, August, July, prior to this price action, what was the lowest low? Here. What kind of liquidity would be resting below that low? Now, I often tend to say price is targeting retail liquidity. When I say the retail, I don't mean your MT4. I don't mean your broker. I don't mean what you're doing. What you're doing is retail, but is not enough to register on the interbank price feed. Okay, because your liquidity is still minuscule. So the entities I'm talking about as retail are fund level entities. These are corporations. You're not individuals. They are corporations with large, very large equity, and they trade contract sizes. You're not trading lot sizes and all of those things. And what I've taught you guys before is that the reason why the market moves is due to the correlation between the central banks, which are liquidity providers, or which are the primary liquidity providers, and all the other market participants, which we call large speculators. And they range from hedge funds to private banks to commercial banks to investment firms to trading floors. These all constitute, to multinationals, these all constitute large speculators because of the large order flow they possess. Okay, so that relationship of the central bank sometimes cannibalizing on these large entities is what creates reversals at these certain points. Okay, remember, these entities, your long-term trend following. Okay, so if they see the market expand below a long-term low, to them, that is a long-term shift in order flow. And they would want to be short. So what type of liquidity is going to be rested down here? Protective sell-side liquidity from fund level entries who are long inside this parent price swing. They're entities who are long. Okay, I don't know what strategy you're using. I don't know what analytical tool they're using. But there are entities who are long inside this price range. So if they're long, just like you are, okay, and you're on the trade, you're gonna look to cut your trade at a loss, and you don't wanna leave your, you don't wanna trade without a stop loss because that could blow your account. And that's the same thing with these entities. Now, definitely, they have deeper pockets than you, and they can ride long-term moves like this, okay? But they need to cut their ideas short at a level. Longer term lows. Okay, so by price trading down into those longer term lows, the central banks can cannibalize on all these participants. Now remember, as price trades higher, who is providing liquidity for higher prices. It is the central banks. And that's why I taught the central bank hedging program in module 1 of the course. Okay, so liquidity is being provided by the central banks to these large speculators, and they're not the ones driving prices higher. Okay, the algorithm drives prices higher due to the provision of buy-sell liquidity by the central banks to large speculators. Now, at these reversal points where these entities are chasing what they think is the trend, okay, that's where the central banks can book a profit off of them, because now central banks shift delivery after building in a short against all the hedging program. So as price rallies higher, they are buying. They're selling. Who are they selling to? They're selling into large speculators who want to buy in alignment with the trend, because these large speculators are long-term trend following. Okay, so that's how they provide liquidity. And then as they shift at their net short up here inside the small order range, and market order flow shifts, okay, these central banks will start to mitigate their long-term built-in positions, okay, by buying back. Now they're providing sell-side liquidity. Okay, they're providing sell-side liquidity. Who are they providing sell-side liquidity to? To the large speculators or trend following. So as the large speculators are chasing the moves lower, there's also going to be participants who are long inside the range, and they have protected sell stops here. There's also going to be participants who are wanting to be short in alignment with the trend, and they have pending sell side liquidity in form of sell stops resting down here. So when the market goes down there, they want to be short because they believe that the market should be bearish from this long-term shift, and that collectively creates a pooling of fund level sell side liquidity pool, and that's how you get sell side liquidity pool in price. So we have open float on the sell side, okay, and that open float is what we call sell side liquidity. So here, this is that sell side liquidity in price. And what you can see there, let me get rid of the replay tool. Now what you can see there is we have a longer term sell side liquidity. But now external to this price swing, if you looked closely, you can see prior to run lower and a shift in delivery, we had a short term low. Now if you went back to the definition, so if you rewinded the video back and you went back to the definition of where we have pending or existing liquidity, you would have seen that we talked about liquidity in sell side form, sell side resting below the lows, the last short-term low, the lowest low in the last 3 months, the lowest low in the last 6 months, and the last bullish shift for the sell side. Okay, now what is the lowest low in the last 3 months? That's this low here relative to this price action. So when I'm saying this price action, I mean here. Okay, so relative to that price action, the lowest low or the last bullish shift, if we have a short term high here and prices run higher, retail considers that a bullish shift. Okay, this is the lowest low. So now what will be resting down there? That's going to be sell side liquidity. As price trades lower into that sell side liquidity, let's look at dollar real quick. Does dollar confirm lower prices? You can see as price trades lower through the sell side liquidity on USD/JPY, dollar is also trading lower. Okay, so very clearly the trend is bearish on USD/JPY. Awesome. Now, who is selling short? Who is chasing the sells below the short-term low? The funds. Why? Because the funds are long-term trend following. Remember, at this point here, it looks very bearish. It looks like it is long-term bearish. Now, after hedging into the longs provided, the central banks here will then start to reaccumulate, okay, against retail. And when I say retail, I mean the fund level sales of liquidity. What are they doing? They're shifting delivery from provision of sell side to now provision of buy side. Remember, as price declines lower, they're buying, then they're buying, then they're buying, then they're buying. And then down here, as these entities chase the trend, okay, the central banks will start to aggressively provide the buy side liquidity, because now they're extremely net long. Okay, as price declines lower, they are extremely net long down here. As the funds are chasing the shorts below here, and this is why I mentioned that these fund level entities, they get cannibalized at turning points in price. Okay, at turning points in price, that's where they suffer the most, because no one else except the outside the central banks knows when the trend is going to change or the trend will shift. Now remember, the primary function of the central banks is to provide liquidity to all the market participants, but they can also book profits for themselves at these turning points. Okay, and guess what's happening? The pending sell stops here, selling order from the fund level activated. Okay, we're assuming, I'm not saying you're setting sell limit orders there on GM4s. Obviously that's not the trade, but they're chasing the shorts here. Okay, so as they're chasing the shorts here below short-term low, which is confirmation to them that they are in sync with the trend, look what happens next. Price is consolidating. What's happening in the range? Okay, what's happening in the range? The consolidation is to building new longs. Okay, and price trades back down into the range. Remember when I talk about institutional sponsorship, you're looking for displacement. You have displacement here after running a short-term low. Price trades back down into a discount, which is an old era of provision of buy side liquidity, and then you have a shift in structure above this short-term high after running out sell side. That's a shift in structure. Okay, now if there's a shift in structure, all the entities who are short below this low here, where would they have a protective stop? And this is where you look back or you cast back. Okay, where is the most recent complete month? January was most recent complete month. Now if you cast it back 20 days, like I taught you on the last video, where is the pending buy side liquidity in your 20-day IPDA data range? It is this high. So now on the last video, just correct that real quick. On the last video, we would have used January, okay? Because the last complete month. If I brought on, okay, I don't think I can bring that on. This is January and this is February, okay? February is not a complete month, so we cannot use February. Now the last video, I would have used February to delineate the look back period. Okay, so this is a correction on that one, on that video, on that lesson. So if January is a complete month, you start from January, the first day of January. That's where you start from, not from February. Okay, so just to clarify real quick. So our complete month is the month of January. So we do our cast back from January, and our 20-day IPDA high is up here. So you know that the fund level liquidity who are short will have protective buy stop above here. So in this context, we have open float at 138 big figure number. Okay, we're assuming this is a shift. So this is this is making a higher low in price. If USJPY is making a higher low in price, we would like to see it be confirmed with a lower low on dollar, which will indicate that we have underlying strength or accumulation on dollar yen. So let's see if that is that actually happens. And you can see there, as USJPY is running higher beneath fund level sell stops, okay, accumulating longs, dollars running lower. So we have a confirmation play here that we are on the side of delivery or order flow, okay. And then the market will go and seek open flow at 1.38 because that is where we have our 20-day high, okay, which is going to be buy side. So start delivery, just in replay tool, and you can see we tag that. Now remember, the borders of the candle, especially on fund level play, is where the bulk of liquidity is. So we don't necessarily need to really expand above the high. Okay, the borders of the candle is sufficient enough for a run on liquidity. And so what happens? As we run above there, we have a measure of distribution coming to the marketplace. Okay, so now here, central banks start providing buy-side liquidity to the funds. Okay, and we have provision of buy-side liquidity. And where's the market reaching for? The market is reaching for counterparty liquidity. Why? Because any individual or any entity who is long here, they need efficiency, okay, in form of counterparty liquidity to pair against buy-side liquidity. So if you are on a trade for a buy, you cannot exit that trade if there is no counterparty liquidity for you to close your execution. So if you took a buy in USDJPY, and then your broker on your M24 or your M25, you clicked on the close button to close out your trade in profit. Okay, who took the other side of your trade? Now brokers typically, they can either pair your trade up against another client within their firm, okay, or they can decide to take on the risk, which is what a lot of them do, because statistically, traders lose money. They can decide to take on the risk of your transaction, and they act as your counterparty liquidity. In the first example, if they paired your order against a client who's looking to do transaction counter to your execution, okay, that client becomes your counterparty liquidity. If they took on the risk themselves, they are your counterparty liquidity. Now, sometimes they can just directly impute your order into the interbank price feed. Then the interbank price feed becomes your counterparty liquidity. Okay, but the key point I'm driving at here is you need counterparty liquidity for transactions on your M24 or your M25, and that's the same play on the fund side. Okay, on the interbank scale, these entities cannibalize on each other. Okay, so as the central banks provides liquidity to these funds or these banks, they need buy-side liquidity from individuals who are short inside this range and individuals who are looking to get in sync with the new delivery price at this 20-day high. Okay, so if we can drive price up there, all of that liquidity which has been pulling above the short-term high is now triggered. So if we were long here, and when I say we, I mean we're role playing as the central banks. If we're long here, then we can offset our longs against counterparty buy-side liquidity. Okay, so again here you have a market structure shift, which happens here. Okay, the market does not shift structure here because we don't break a short-term high. We have a market structure shift here, which is confirmed with SMT. Okay, we're not going into the marketplace looking for SMT. If you saw my analysis initially, I never mentioned SMT as our tool for analysis. Okay, we already know logically how price should deliver. The moment we see displacement with inefficiency like this is institutional sponsorship, just like we discussed. Okay, because we have a break of short-term high. It does so with energy. Prices coming off of a discount after creating a small little range, and that is now confirmed with intermarket divergence. Okay, which is SMT. So we know that price is going to seek the next level of liquidity, which is a 20-day high up here. And that's why we have this liquidity as our IPDA high in price here. Okay, and you can see price runs up there and clears out open float on the buy side. Okay, now if we have open float on the buy side, where is current open float on the sell side? We have 2. After taking out this side here, we have a new buy side liquidity up here. So let me annotate this. Okay, in form of buy stop. We have sell side liquidity here, which is an old low inside our apparent pricing in form of sell stop. We have another sell side liquidity down here, which is our external liquidity to our apparent pricing. And then we have a discount. Where is the discount? All of these down candles, balanced price range here, that's a discount. Okay. Now, watching market delivery, we have a shift in structure after running out the buy side. This is start of March. Where is the most recent complete month? February. To start doing a look back. If we look back from February, looking at price action, is there anything that stands out in form of premium or discount that higher time from order flow can reference? No, not really. Why? Because all of this price action has been mitigated by all of this. So this is what takes precedence. Okay, only thing that stands out is this balanced price range down here, which we can annotate as a discount array. Alright, and then looking at current price action, we use a replay tool. We do have a fair value gap, a premium, after running out a short-term low and then a short-term low here. Now let's watch this high, which took out this buy side liquidity with a shift in order flow. You can see prices clearly respecting premium, that's respecting discount. Is that confirmed with an SMT? Can we confirm that with SMT in price? If you look closely, do you think we could confirm that with an SMT in price? Yes, we can. Why? If you looked up price on the closing basis, dollar yen runs lower, while dollar itself runs higher. So if you don't understand what I mean by closing basis, just simply go to your line chart. You can see what I mean there. Okay. And just to get rid of this, so we have a lack of confirmation of a breaking structure against dollar. So that means we could see a run for discount and sell side liquidity potentially too. Now price shoots up into this bearish value gap, anticipating displacement lower. And we have a redelivery balance here. This candle, which I've taught before, this candle, thin liquidity there. And then your fair value gap starts from the low of this candle to the eye of this candle. And that's a fair value gap right there. And price just up there. You can see wonderful response there. And it has gone for sell side. Why is the sell side important, Jin? Because the sell side is at a discount. So that is a discount array. Remember when I taught you institution reference point? What's your discount array? bullish order blocks, bullish fair value gaps, bullish inefficiencies, bullish breakers, bullish mitigation blocks, and then old lows and bullish rejection blocks. So remember, an old low is also a discount array. That's this right here. And as price trades down there, it trades down into a balanced price range. Now watch this. Do you think this is bearish right here? No, it is not. Why do you think this is not bearish right here? Because if you went all the way out, remember, we're still external to this sell side liquidity. So if we run below this low, the funds who are short here, they have a chance to be able to mitigate from being in drawdown for a while. So we don't want that to happen. So we will want to see price run up into a premium relative to what range? To this new parent price swing. This high up to this low. If you take your Fibonacci and did your range measurement, you can see equilibrium of the range is up here. So we're going to want to see price run up at minimum into equilibrium of the trending range. Again, it's all a play on liquidity and open flow. So now we have open flow on the buy side resting up here. We have open flow on the sell side resting down here. But this is less probable, and this is more probable because we're using the play on this sell side liquidity here. Okay, that we had a run on sell side liquidity here, and we've seen willingness in price to want to displace aggressively. So all of this is all institutional sponsorship. We had a break above the last 20-day high. So if we did our cast back to the last complete month and went back, okay, you can see that this high is a 20-day high from current market price action. Actually, it's this high here, and then this is 40 days, and then this is 60 days. High side there. Okay, so that will be target drone liquidity at bare minimum. And then so what happens next? Price starts to run higher. Okay, now what we're looking for is this price respecting premium or respecting discount. It is respecting discount. It trades down to bullish order block after run out sell liquidity and trade down to BPR. You can see delivery there, down into a propulsion block. You can see displacement there. It's making higher lows. That should be confirmed with higher lows on dollar. Okay, dollar should also make higher lows, but dollar is not. So it is showing strength against a bearish dollar, meaning we have institutional sponsorship on dollar yen. Okay, so let's remove the replay tool here, and you can see where current market price action is. I personally think we're going to run above this high. So again, this is a forecast. I believe that USJPY should at least try to close in on this inefficiency. We trade up into that inefficiency. A bare minimum, we should try to close up into inefficiency and run above the short term high or intermediate term high in price, because this is where we have buy side open float liquidity. Okay, now I know a lot of structured traders, they use breaking structures and everything. Again, you're not, as an institutional trader, you're not looking for breaks in structure. Everything you do has to be relative to where you believe the most prominent fund level liquidity should be resting at. Using the relationship between central banks and these funds, using the market maker hedging program, okay, using that to aid in your prognostication of where the most likely drawn liquidity is next. What you're looking for and when structure actually works is when you're on side of where the liquidity draw is. So if you're anticipating bullishness and you can see a break of a daily high, okay, which is confirmed, again, it does not need to be the case every single time, but oftentimes it will be confirmed with divergence against a correlated asset. That is a very strong tool or indication that you're on side with central bank delivery. And what you can do is for the next couple of weeks to the next couple of months, you can trade on a one-sided basis. Okay, you're simply looking to be a buyer most days during the week, Tuesdays, Wednesdays, Thursdays if you're bullish, or you're looking to be a seller. Okay, most days of the week, Tuesdays, Wednesdays, Thursdays if you're bearish in terms of daily delivery. And this is how you can get in sync with daily delivery on the lower time frame. So I'm going to teach how you can align your daily biases with lower time frame delivery, but this is the first and essential step towards your prognostication of draws and liquidity. Without understanding where fund level liquidity is resting and how price should be drawn into those levels, then your lower time frame prognostication will really take a hit and will really suffer. Okay, so this is the framework for trading other time frames. It all starts with understanding how price is being sponsored on the higher time frame. So essentially, open flow is a study of how the market reaches for pending or existing buy-side liquidity and or pending and existing sell-side liquidity in the marketplace. All right, so the next topic we're going to go to is we're going to go into using IPDA data ranges for our analysis. Now, what is the point in using IPDA data ranges for analysis? First off, imagine you are a trader. No, not a trader, sorry. Imagine you are a programmer or you are a software designer. You're designing a software. Okay, which I used this example before in the previous lesson. If you're going to design a software, you need to draw data from somewhere, okay, for your software to work. You need data, a set of data, to program your software to work in a specific fashion or a specific way, okay? And what we're doing with the look back period, which I just did in the most recent example, is we're trying as much as possible to mimic what we believe the central bank algorithm is doing in terms of seeking these fund level liquidity, because that's the relationship. By their nature, they have to provide liquidity to other market participants. Okay, so the relationship is central banks provides liquidity to fund level participants, and then through interbank price feed, and then these fund level participants become liquidity providers to smaller liquidity providers like smaller banks and stuff, and then those guys become liquidity providers to your broker. Then your broker shows your the price that's fed to him on your M24 or M25, okay, which all stems from the numbers being imputed by the central banks, okay, because they control the liquidity, right? Now, that's the main job of the central banks, to regulate the currency that they're lords over. Now, another function which they capitalize on is by capitalizing on, or cannibalizing on the other market participants, especially at turning points, okay? And they use data sets, which again is not done manually. It's all done algorithmically because of the high speed transactions going on every single second. Okay, every single second, just billions of dollars being moved around price. Okay, and it's not done by a person. No one person can handle all of that work. No group of people can handle all that work. It's all done from the skill of high-speed computers, okay, which are all programmed to deliver price efficiently. And that's why we talk about efficiency in delivery and inefficiencies in price, okay? And what we're trying to do is we're looking for liquidity in the range of the last 60 days that the algo will mark and has to deliver into. That's what we're seeking. So the question we're always constantly asking ourselves is, where is the sell stops? Or where is the buy stops? Or where is the fair value gaps? Or where are the liquidity voids or equilibrium within the last 60 days? Okay, so now within the last 60 days, we have a range of 20 days and then 40 days. But that is our data set. So within those data sets, we're looking for key reference points that the algo is going to reference to deliver price into. Okay? Now imagine just no data set. Imagine I did this. Imagine this is the only data you have to reference. This is current market price action, and the only data in the entire history of this asset is yesterday's candle. What do you think is going to happen? Do you think there's going to be efficiency in delivery? Do you think there's going to be any form of prognostication? Do you think there's going to be any form of price aligning with your bias or anything? Of course not. Of course it's not going to be, because there's not enough data to reference for delivery. It is not efficient enough with this one data set. That's why we need a set of data for function for current market price action. Okay, so remember, there is no randomness as to how price moves around. It is all pre-planned, it is all pre-priced, it is all specific. Okay, so you can work the way the interbank algo works by casting back 60 days, finding the reference points, and then casting forward 60 days from current market price action. Okay, and using that to your advantage to anticipate where the draws on liquidity is or are. All you're doing with the cashback is you are drawing your attention to sensitive points in price where fund level liquidity are going to have pending interest in form of open flow. That's why we mentioned open flow before we talked about utilizing IPDA data ranges. Okay, so by casting back, what it also helps us do is it helps us identify the quarterly shifts. Now, the reason why I'm anticipating that USJPY should most likely trade up here versus trading down here is because if you look at the last quarter, so last quarter is again using your IPDA data range. Current month right now is April. Last complete month is March. So if you look back, where did we have a quarterly shift? Here. Okay, that was 2 months ago from our cashback, or that was within our 60-day range. That was where we had a quarterly shift. So the anticipation is we should trade in alignment with that quarterly shift for buy-sell liquidity. Right? That's what we're looking for, and that's how we're making this anticipation. That in the immediate term, we should see dollar yen try to run for 138 big figure number again. Now, if it tries to run for this sell-side liquidity, then that would mean that the algo has viewed this as a run and buy stop, and that's sufficient enough to get in sync with the longer term trend of bearishness. But we're saying no, or I'm saying, no, we're saying, okay, I'm saying, because rather run a sell-side liquidity and fund level liquidity are now trapped, we need to at least run a level of buy side. So at bare minimum, I would like to at least see this liquidity get taken out. Okay. And then if we can take out this liquidity on the buy side, then we should try to reach up here on dollar yen using our tool of and again, I think this is the last, this is the last trading day before the new month forms. So once the new month forms, which is the next trading day, that should be Monday, our cashback shifts to here, and then this eye comes into consideration, which is why I'm on the analysis, because we're very close to closing out the month. I'm looking at this as our drawn liquidity in price, using the cashback as a reference where the algo should reach in for. But I want to see price run above this eye first. Okay. So again, this is all like a forecast kind of play on our course video. That should be interesting. All right, so we have a look back period of 20 days, 40 days, 60 days, and then we have the cast forward period of 20 days, 40 days, and 60 days. Again, it's not really that important, but again, all we're looking for is we're using that to project what we believe the quarterly shift should look like. Okay, so if we believe there was a shift in delivery, the most recent shift in delivery is down here. We had a run on the sell side, run on the lows. Okay, and if you compare that against dollar, and this run lower here, so let me just real quick. You can see very clearly that dollar was running lower, all the while dollar was running lower. Okay, dollar yen was running higher in price, which shows that there is underlying strength in this asset, and it should see displacement or it should see sponsorship on the upside in price. Okay, the essence of IPDA data ranges is to seek fund level liquidity. That's the entire essence. It's just to draw attention. Again, that does not necessarily mean, and I've told you guys about this before, I don't go on my chart doing all the things you're doing. I go on my chart doing the lines and doing 20 days, 6 days. I don't do any of that thing. Because I'm already used to doing this, so I can go eyeball the levels and I already know where the next round liquidity is. Okay, but what this does is it trains you to learn how to view what reference point price should be drawn towards, or the central bank should deliver price into. Okay, now this does not mean that every 20 days, 40 days, or 60 days price will make a turning point or make a new shift in delivery. Okay, all we're looking for quarterly shifts to take place within the time period, or when we identify one, that's the beginning of delivery for the next quarter in price. Okay, that's what we're looking for. Now, while on the intermediate term time frame, our delivery of price is driven by the relationship between central banks and the large speculators done by the algo on a macro scale. Okay, I'm talking about monthly, weekly time frames, over a time frame of a year, 6 months. This is all driven by interest rates. Okay, interest rate is what makes the markets go around. Interest rate is what makes the currencies go around. Okay, currencies directly tied to interest rate. I'm going to teach you guys interest rates in this module, and because we use that on a day-to-day basis for our analysis, and we use that to define high probability conditions, medium probability conditions, low probability conditions, and when we can invalidate a trade using the interest rate. We use all of that to define interest rate. To define market conditions. Okay, but on a macro scale, currencies are driven by interest rates. On a macro scale, that's why interest rate announcements, news, they're very volatile. Sometimes, or most times, they're very, very volatile because they have an impact on intraday price action. On macro scale, our delivery is based off of interest rates. On a quarterly scale or a quarterly delivery basis, our delivery is based off of IPDA data ranges. Now, the IPDA data ranges on the quarterly scale will get in sync with what the macro scale is indicating in form of interest rate for currencies, since we're trading currencies in this conversation. Okay, and long-term fundamentals are not impacted by 3 to 4 month cycles. They can be used to get in sync with long-term fundamentals. Okay, so long-term fundamentals, again, they're interest rates. What IPDA is doing is that it is giving you reference point with specific days and specific price points. It lets you know what stops they're reaching for above an old high and below an old low, in form of open float liquidity. And that's what it is doing. It's simply drawing your attention to where the next open flow liquidity is. And as a trader, all you need is the next open flow liquidity. Once you can define where the next open flow liquidity is, all you need to do is you need to time your entry and sync with that drawn liquidity. And that is the basis for all lower time frame transactions, aka all lower time frame executions. The basis for all lower time frame executions is what you're being taught right now, which is where the drawn liquidity is on a quarterly basis, okay, or on an higher time frame basis. Now remember, if you've exhausted your reference point within the last 60 days, you can look outside the 60-day range. Price is not limited to only the reference point within the last 60 days. We're only saying for intermediate term plays or intermediate term shifts, okay, the algo will reference points within the last 60 days of price action. Now here, looking at current market price action, if I use what I talked about in the previous lesson in terms of using a current market price action to define the last 20 days, 60 days, 40 days, and then 60 days look back. Excuse me. Okay, I remember I mentioned there are two ways of using the look back data to identify your reference points. Okay, you can use the most recent complete month and do your cast back to identify your 2060 day ranges, and you can use your current, meaning you're using current market price action, and you're going back to identify quarterly shifts. So if we went back 20 days from here, and then 40 days from here, and then 60 days from here, you're going to see that this is our 60-day high, which is why I believe that this is general liquidity from current market price action. In form of a discount, we have this high here, which is why I want to see this get taken out first, because that's a 20-day high from current market price action. Again, this is a data set. Within the last 20 days, our data set ranges from this candle to this current candle. So that is a reference PDA raise within the last 20 days. Our discount is this bullshit block. Our premium is this hold out here, and then the rejection block here. But I don't think we're just going to stop at the rejection block. We're going to go higher. I'm going to have to trade through the rejection block and up into this hold eye here, okay, as our target drawn liquidity. And then we have this fair value gap and bearish order block to take into consideration as a premium. So all it is doing is it is drawing your attention to where the next open flow liquidity is resting at. That's what the look back is doing. And you can use it, especially if you're trading actively. If you're starting off your analysis, and how I used to do that in the past is, if I was starting off my analysis looking for quarterly shifts, okay, I'll start with the most recent complete month. Once I've identified quarterly shifts and I've identified where draws on liquidity are, I start my cast back from current market price action, and I go back and I work my way back, looking back 20 days, 40 days, 60 days, and I look for salient PDA arrays that should be draws on liquidity, and that becomes my bias. And also what I'm looking for is I'm looking for a quarterly shift within that time period, because this is a range of 60 days. Okay, how many is 60 days? A trading month is 20 days because we don't trade during the weekends. So a trading month is 20 days. Okay, 3 trading months is 60 days. So that is 60 days of data, or 3 months of data. That's enough to identify the quarterly shift. And this is a video you're probably going to have to watch a couple of times to fully grasp the concept of what I'm teaching. Okay, and I said I don't want this to get over an hour, and it's almost over an hour, and we're not even halfway through the content. This is why I said this lesson is really because I have to explain in detail what I'm trying to communicate across. Okay, now we're going to go into using open interest to define market direction, and I've taught you how to utilize SMT or divergence against a correlated asset to identify market direction. Okay, and now we're going to, and I've also taught you how to use the castback. Again, I'm not really focused on the look forward, so just a look forward part of this lesson, which is You look for 20 days, 40 days, 60 days, and you're using that time period to identify if, open flow liquidity draw, and, if there is a shift, if there potentially is a quarterly shift in price. But you don't really need that, because all you need is just to know what data sets you're looking at and what is the most likely draw based off of the proximity to current market price action, which I just showed you right now. And that's why we're looking at this as the short-term play. So if I was trading on a day trade, I'll be looking to go long off of a 1 hour, a lower time from discount, looking to aim for this as a weekly objective, and that'll be all for my execution. I'll be looking to do so inside this range just low to the side, because that is the range within my 20-day data set. If I was looking at the entire range of my 60-day data set, then that brings my attention to this side here. But I don't need to do that, because I'm not trading swing trades. I'm trading short-term trades or day trades. So I only need the data set within the last 20 days, since I know that's the near strong liquidity to look for executions in alignment with. So you see how I broke everything down? Again, I don't need for price to go all the way up here for me to make money. I only need a portion of that move in the last 20 days. Now, if we traded above this here, now we're trading outside our data set within the last 20 days. So this becomes null and void. So what do? We go back 40 days. Is there any data set we can reference a premium in the last 40 days? No. Why? Because the data set within the last 40 days, they're all at discount. So we have to go back out again to the last 60 days. Now we have a data set to reference, which is this bearish order block, and then this old high here, and that is our data set to reference within the last 60 days. And then any trades we're doing on the lower time frame will be in reference to the data set within the last 60 days if we're looking for bullishness, or we're looking for potential retracement against all this run higher. Hopefully this makes sense. Okay, so now, how do we use interest rates to determine market direction? First of all, what we need to understand is we need to understand that price is moving based on where the large fund orders are. Okay? And where the large fund orders are is essentially where the highest probability open flow is. The banks give traders opportunities to work inside a position and capitalize on the move that IPDA is working for them. So now, when we talk about the banks in this example, we're not talking about your regular banks. We're talking about smart money liquidity. Okay, so how do we know when the banks, aka smart money, is going to buy or sell? Using open interest. First off, let us define what open interest is. Open interest is a tool you can find on www.borrowtrade.com, and I will type this out because I know I don't talk clearly sometimes. So you can go to www.borrowtrade.com. You can create a free account with them, and right here I have my yen futures chart. Let me show you why I was able to access the yen futures chart. So you go to select commodities, and you can see you have your commodity here. You have your section, grains and oil seeds. Sorry, I'm slurring my words because it's 3 a.m. and for some reason I'm still up working. You have grains and oilseeds, you have energies, and grains and oilseeds, you have wheat, corn, soybean, oats, rough rice. These are all assets you can trade, by the way. And then you have energies, and on energy you have ethanol, natural gas, oil, and then you have metals, and you have livestock, and you have softs and indices, and now you have currencies. So you go to the section that is currencies. Here, you look for yen. Again, we don't do open interest analysis on dollar. Why? Dollar is not an asset that is heavily traded. It is a reserve currency. Okay, so when I say heavily traded, I mean traded for speculation. There's a difference between trading for transaction versus trading for speculation. Dollar is not an asset that is heavily traded for speculation. Okay, it's only used as a reference currency So you don't see anyone trading dollar itself because it is a reserve currency. But they can trade other assets value against dollar. Okay, so that's why we don't want to do our fundamental analysis on dollar. When I say fundamental analysis, I mean monitoring fund level liquidity play. We're not looking for that on dollar because sometimes the data can be skewed because of the low volume of transaction in dollar. So we use other assets, and in this one we're using yen because on our pair we're looking at, which is the JPY, you can see yen is the pair or base pair. Sometimes I get it confused by now. All right, so you go into full chart, and also, by the way, something I forgot to mention: when you're selecting the contract month for your futures contract to do your analysis on, you always want to make sure you select the most recent month. So our most recent month, or our nearest contract month, is May. Okay, because we're going into May, so we want to select May as our nearest contract month. You go to full chart, and this is our chart on yen. Okay, so here you can go and look at the tools, trend lines, horizontal lines, and everything. Here you can add your indicators, and for my open interest, I have the volume indicator. So you go into your search for studies, type in volume, and you just click on volume. Don't click on anything else. You only click on volume. Okay, and then if you click on volume, it should show you this, and you can just apply. You don't need to do any settings or anything, but make sure that open interest line, so you can see here, just open interest in bracket line. Make sure that is applied there, and you're good to go. Okay, and now we have our open interest. Now let's define what open interest is. What is open interest? All right, so open interest is the total open longs and short in the marketplace at a given moment, just like open flow, but it is existing liquidity, not pending liquidity. Remember, open flow can consist of both pending liquidity and existing liquidity. With open interest, we're only concerned with existing liquidity. Why? Because we're looking to track the existing liquidity of the large funds on the asset we're looking at, because that will give us a clue as to what the delivery or what higher time frame order flow is, and that helps to contextualize what open flow liquidity price is reaching for. Okay, let me just take a very quick look at the timing, because I'm trying to keep this as short as possible. I think the last one was an hour and 5 minutes long. I don't want this to get to almost 2 hours of content because it's going to be extremely boring to you guys who are watching. So now let's define the parameters with this. If the central banks is a storehouse of currency, if you're trying to buy currency, it has to be made available to you by who? Is it going to be made available to you by a broker? No, because your broker is getting the feed from somewhere. Who's your broker getting the feed from? From a liquidity provider. Is the liquidity provider the one setting the price for that currency? No, because your liquidity provider is also getting the fees from someone else. Who's it getting it from? From the central banks, because they set and control the price of that specific currency. Okay, so if you're trying to purchase a currency or you're trying to buy a currency, it has to be made available. In this example, yen, it has to be made available to you by the Bank of, Tokyo or Japan or whatever they call it. That's the Bank of Japan, the BOJ. Okay. If the Bank of Japan is providing the basis of valuation to the yen, that means that they are counterparty to all the large funds. Not necessarily all the time, but mostly so. And this should be a light bulb moment in your head. Like that. And when I was going through this, because I have multiple journals, and on one of my actual notebook, I wrote, finally, it makes sense. Because again, remember, the difference between yourself right now and a lot of other quote-unquote institutional traders is a lot of them are looking at price from the perspective of how do I understand the technical analysis side and look for patterns, the AMD pattern and the breaker block pattern trade. Your job is to understand the underlying reason why price actually moves. Because if you can understand the underlying reasons why price actually moves, you can do things that will absolutely blow the mind of your quote-unquote classic institutional trader. Because you're not there to understand the reason why price is displacing or the reason why there's transactions on price. You're only there to try to make money by looking for patterns, and that's the retail mindset, and that's what I tell you guys to shy away from. Okay? So you want to view open interest as every trade in which the central banks are providing a counterparty liquidity, which is essentially the same as what a small brokerage firm will do to its own clients. Okay? So, again, that means the Bank of Japan, BOJ, is essentially a liquidity provider for the yen. So, if we have defined open interest as the total open longs and shorts in the marketplace at any moment, that means if we see open interest increasing, that means the central banks are taking on the risk. Why? Because open interest is the net total open longs and short in the marketplace. So if open interest is increasing, that means the current open position on that specific asset, so in this example it is yen, the current open position on yen, be it long or short, is increasing. So that means liquidity is being provided by the central banks to the funds or to the buyers of yen, because we're seeing open interest increase. When we see open interest decline in a consolidation or a rally, that shows an unwillingness to continue to sponsor current open position. Okay? Again, I don't want to have to repeat myself, and I'm trying to stress and emphasize this, but my mouth is very dry right now, and I don't want to go back and forth. Number one. Number two, the video is already so long, and I don't want it to be even more long. Okay? So, what I want you to do is I want you to go back and rewind the last few seconds to really digest what I just said, because I can't stress this enough, but it is extremely important to understand of open interest. If you see open interest declining in a consolidation, or when price is rallying, that's a warning sign, because that means the central banks, they're unwilling to continue to offer liquidity to buyers of yen. I'm using yen because that's the example we're looking at. Anytime open interest increases, it means the central banks are offering liquidity to buyers. Thus, if we see a rapid decline in open interest in a consolidation, it shows a lack of willingness by the central banks to provide liquidity for the buyers. All right, so let's go through market price action. There's going to be a supplementary video to this. And by the way, so for each lesson, which I think I've mentioned before, for each lesson or content I record, there will be a supplementary video to that lesson or content, just to aid in the understanding, because this is one complex topic to digest and it's very lengthy. And if you look at the time right now, it is around an hour, 14 minutes into our conversation, and it's getting very, very long. Again, this lesson is not an open interest. It's just simply an introduction. If you look at the course module, an hour time frame, there are 2 more extra lessons on open interest and commitment of traders report analysis. Because you have that's lesson 6 and 7 of the hour time frame course. We're going to delve deeper into this, and I know you probably have questions about all of this. We're going to touch on all of that, and you're going to see more examples. It's gonna make sense. Okay, so now in this example, you can see yen was bullish. Now remember, this is USD JPY. Okay, what is the pair that comes first? Dollar. So that means anything yen is doing is going to be the inverse on USD JPY, because USD JPY is the pair that comes first. Okay, so you can see yen was rallying, and after yen rallied and took out a long-term high. What's that long-term high? The highest high within the last 1 year was this high. After we traded up above that high, we went into consolidation. Now look what ensued in the consolidation. We saw open interest decreasing. Now what was the current? Remember the definition of open interest? It is the total open longs and short in the marketplace. Now if the trend is bullish, what does that mean for the open interest? It means we have current longs in the marketplace more than shorts. Okay, the longs in the marketplace right now, they are more than shorts. Okay, so we're seeing, again, it's not supply and demand. It's just simply the number of institutions or large speculators that are on one side of the marketplace. So clearly, buy-side liquidity is being offered to the funds by the central banks. Okay, now inside this consolidation, after running out buy-side liquidity or open flow within the last 12 months on the buy side, open interest was declining, which shows a lack of willingness to continue to sponsor or offer buy-side delivery. What happens next? It starts to tank, and open interest is increasing. What does this increase mean? It means we're now starting to sponsor this distribution lower, or sell side, meaning the central banks are now starting to sponsor sell side liquidity. That's what distribution means. Remember, after run out buy side liquidity, we stopped and we started to decline actually. Okay, so that decline at this run on liquidity indicates a lack of willingness to continue to sponsor or offer buy side liquidity by the central banks. So they are aggressively reducing positions, or they're aggressively reducing offering of buy side liquidity, and then starting to take on sell side and offer sell side liquidity. And then here you're seeing an increase in open interest as the market declines lower. And then as we start to rally back up into a premium, shouldn't open interest be increasing if we are actually bullish and this is just a retracement in the market? Should open interest not be increasing to show that there is now offering of buy side liquidity? It should. So, but it's decreasing. It's not increasing. That's weird, right? So when you see an increase, when you see price rallying like this after we make a quarterly shift, when you see price start to rally up into a premium and that rally is not followed through with an increase in open interest, that indicates that we're actually not offering the buy side. Okay, there's a lack of willingness to want to offer the buy side, and you can see what this is after. And that run lower is what translates to higher prices. So at this range here, where we had the divergence with dollar after a run on external liquidity within the last 6 months, open flow liquidity on the sell side, that was actually confirmed with open interest, indicating that there was a lack of willingness to continue to sponsor the buy side. So that was your confirmation play. The moment you saw a breaking structure here above the short-term high, you have a confirmation of open interest, you have a confirmation of SMT against dollar, you have a confirmation of a run on sell stops, and then you also have a confirmation of a shift in delivery with the clear zone liquidity, which was at this time of this happening, a 20-day IPDA high. So with that being said, I'm going to wrap up the video here. It's been a very long video. Just going to be follow-up supplementary videos, and I hope you guys will have a wonderful weekend. Trade safe.